Ever wondered why Robert Kiyosaki, the author of Rich Dad, Poor Dad, insists that your house is not an asset but a liability? This intriguing concept, introduced in his best-selling book, challenges the conventional wisdom of personal finance. Kiyosaki's philosophy turns the traditional understanding of assets and liabilities on its head, sparking countless debates. So what's the story behind this controversial viewpoint? In this video, we will delve into Kiyosaki's financial philosophy and understand why he views your house as a liability. So who exactly is Robert Kiyosaki? Well, Kiyosaki is a renowned entrepreneur, investor, and author, best known for his book Rich Dad, Poor Dad. Born and raised in Hawaii in a family of educators, he went against the tide to venture into the world of business and investment. In his early days, Kiyosaki served in the Marine Corps during the Vietnam War, after which he started a business selling wallets made from Velcro, which unfortunately failed. But as they say, failure is the first step to success. This setback didn't deter him but rather sparked a journey into the world of finance and investment. Kiyosaki later tried his hand in real estate and found success, which eventually led him to write the book Rich Dad, Poor Dad. In his book, he challenges the traditional thinking about personal finance. He introduces the concept of a rich dad and a poor dad, where the rich dad is his friend's father, a successful businessman, and the poor dad is his own father, a well-educated but financially struggling individual. He uses these characters to illustrate the contrasting mindsets about money and investment. One of the most controversial ideas Kiyosaki presents is his perspective on assets and liabilities. While most people consider things like their house to be an asset, Kiyosaki flips this notion on its head. He argues that an asset is something that puts money in your pocket, while a liability takes money out of your pocket. Thus, if your house is not generating income, it is, in fact, a liability. This radically different viewpoint has made Kiyosaki a polarizing figure in the world of personal finance. Some agree with his out-of-the-box thinking, while others stick to traditional financial wisdom. But regardless of where you stand, there's no denying that Kiyosaki has made us question our financial beliefs. Kiyosaki's unconventional views on finance have sparked many debates, particularly his view on homeownership. But whether you agree with him or not, his ideas are thought-provoking and worth considering in your own financial journey. So let's delve deeper into why Kiyosaki believes your house isn't an asset, but a liability. Now, let's explore why Kiyosaki views a house as a liability, not an asset. It's a radical idea, isn't it? After all, we've always been told that owning a house is the ultimate symbol of financial security. But Kiyosaki challenges this assumption in his book, Rich Dad, Poor Dad. He argues that a house in reality is a liability because it takes money out of your pocket each month. Think about it. Even after you've paid off your mortgage, there are still property taxes to pay, routine maintenance costs, and periodic major repairs. These expenses can add up quickly, draining your resources over time. But what about the equity in your home, you might ask? Isn't that an asset? Well, Kiyosaki contends that home equity is essentially dead money. It sits there doing nothing, not generating any income. You can't spend equity, and it doesn't improve your cash flow. Now let's talk about opportunity cost, another critical factor in this discussion. The money you tie up in a house could be used elsewhere, potentially earning a higher return. When you pour your savings into a home, you're missing out on these other profitable opportunities. For example, if you had invested that money into income-generating assets like rental properties or stocks, you could have earned a steady stream of income, helping you build wealth over time. This is what Kiyosaki means when he says, houses do not make you rich. So, when we take a closer look, we see that a house, instead of being an asset that puts money in your pocket, is actually a liability that continually takes money out. It's a bold perspective indeed, but one that's worth considering, especially if financial freedom is your ultimate goal. So you see, owning a home can be more of a financial burden than a benefit. And this is why Robert Kiyosaki refers to a house as a liability, not an asset. But what does cash flow have to do with all of this, you might ask? Well, let's dive right in. Cash flow, in simple terms, is the money that is moving in and out of your pocket. Robert Kiyosaki, in his revolutionary book, Rich Dad, Poor Dad, defines an asset as something that puts money into your pocket, and a liability as something that takes money out of your pocket. This idea is at the heart of his financial philosophy. Now let's consider a house. Yes, it's a tangible asset, but when you look at it through the lens of cash flow, you might see it differently. Every month there's a mortgage payment, property taxes, insurance, and maintenance costs. All these expenses are continuously pulling money out of your pocket. So despite owning a house, it could be viewed as a liability because it's not contributing positively to your cash flow. This is why Kiyosaki emphasizes the importance of investing in income-generating assets. These are the assets that generate positive cash flow, meaning they put more money into your pocket than they take out. This could be a rental property, a business, stocks or bonds that pay dividends, royalties from a book or a patent, and so on. These investments are the true assets in Kiyosaki's view because they increase your wealth and provide you with financial freedom. Thinking in terms of cash flow, rather than just ownership, can completely shift your perspective on wealth and investing. It's not simply about accumulating assets, but about increasing your income and decreasing your expenses. It's about generating a positive cash flow that can support your lifestyle and grow your wealth over time. So, when we talk about a house or any other investment, we need to ask ourselves, is this putting money into my pocket or taking it out? This question, simple as it may sound, is the key to understanding Kiyosaki's view on assets and liabilities. In Kiyosaki's perspective, it's all about the cash flow, not just ownership. If a house isn't an asset, then what is? This is a question that might be floating in your mind right now. Robert Kiyosaki's philosophy points us towards investments that generate positive cash flow. These are the true assets, according to him. First on the list are real estate investments that generate income. Now you might be thinking, but you just said a house isn't an asset. That's correct. But a house that you live in does not generate income. It drains income. On the other hand, a rental property, for instance, brings in regular rental income, making it a cash-flowing asset. Of course, the key is to ensure the rental income exceeds the costs of the property, such as mortgage, taxes, and maintenance. Next on the list are stocks. Now, not all stocks are created equal. Kiyosaki recommends investing in stocks that pay dividends. Dividends are a portion of a company's earnings paid out to shareholders. Essentially, you're getting paid for owning a piece of that company. Again, the focus is on generating positive cash flow. Lastly, owning a business is another alternative investment. Now, this doesn't mean you need to start a Silicon Valley tech firm. Small, local businesses can be just as profitable, if not more so. The goal is to own a system that brings in money, whether you're working at it or not. That's the definition of an asset in Kiyosaki's book. These investments, when done right, not only increase your wealth but also provide a steady stream of income. They're the antidote to the cash-draining liability that is your personal home. They're the key to financial freedom. But remember, any investment comes with risks. It's important to do your due diligence and perhaps consult with a financial advisor to find the best investment strategy for your situation. Remember, in the world of finance, it's not just about what you own, but what brings you income. So let's start thinking about how we can turn our money into true assets. To wrap up, let's recap what we've learned today. Robert Kiyosaki challenges traditional finance wisdom, arguing a house can be a liability, not an asset, due to mortgage payments, property taxes, and maintenance costs. He emphasizes the importance of positive cash flow and suggests investing in income-generating assets like stocks or businesses. We hope this video has given you a new perspective on assets and liabilities. Don't forget to share your thoughts in the comments, and subscribe to Learnus for more personal finance insights.